Mike, thanks so much for taking the time to participate in our business payments, what's next in payments series. Looking forward to our conversation today about your observations in the commercial payment space, innovation you've seen and where you think it still needs some attention. So thanks again for the time.
No, delighted to be here, Karen. Thanks very much.
So let's put context around the conversation. So as I hinted, you have a long history of being kind of in the trenches in the commercial corporate payment space before Form 3, where you are a co-founder and now CEO. You spent some time at Barclays where that was your remit. So when you look back over that space of time, where has innovation in commercial payments, business payments been most impactful, and where is there still work that needs to be done?
For sure. Yeah, as you say, I'm not sure older than I look or younger than I look, but yeah, a few years in the payment space. Well, I mean, I guess if you wind back sort of 20 years or so, the world was pretty stable, and actually in the business and corporate payment landscape, not a lot changed for actually quite a long time, right? So. Right. It was all about, regularized ACH payments. People were trying to deal with the vagaries of check and manual processes and paper invoicing and all of that good stuff. And I guess over that 20 years, I think there have been a few sort of really fundamental changes in the way that businesses have been able to use payment innovation. So I think the first of those happened when cards really started to move out of consumer and moved much more into sort of critical flows for corporates and for businesses. And I think with that comes more information. With that becomes a better understanding of sort of the real-time nature of procurement processes as well as receipting processes for e-commerce. So I think the first big change clearly was that move into card activity. And then I guess what that sort of has led into is a bigger investment in how you automate that sort of end-to-end process and maybe utilize cards in that space. So, full procurement to pay kind of solutions and how not just the card infrastructure, but also the relationship between counterparties includes more information on trades, on invoicing, on sort of partial payment transactions, all of that kind of stuff. But I guess the bit that's sort of lagged behind that quite a lot and is maybe more of a topic moving forward is that was very card centric, and I guess the account to account rails in lots of markets didn't really keep up with that evolution. So if you look in even markets where real time payments are are mature and evolved, the vast majority of payroll transactions, of rental payments, of mortgage collections, of utility bills, those are all still running on tech infrastructure and user experience that's really been around for the best part of 30 years. So I think there is a significant sort of scope over the next 5 to 10 years to think about how fundamental user journeys in those sorts of areas get transformed by better digital experience and better immediacy of transactions.
But in those use cases that you describe, those are scheduled payments. So it may run over legacy rails, but I think everyone has grown accustomed to the process. I know that payment is due on X date, so I schedule the payment to actually move so that it lands in the account on the day that it is due. There is obviously a lot of value to a more immediate real-time exchange of funds, but that requires a lot of changes that are related to not just the movement of money, but the ERPs and all the related systems that connect to how the money moves. I think it's an interdependent set of decisions and changes that are required.
It is, yeah. I think you point at a really good point, which is, you can innovate around some of the digital experience of those activities, but if they crash into 30-year-old technology stacks, then actually there's just a limited amount of work to do with it. And even those scheduled regularized payments, they're not really super flexible. They don't really deal with many of the exception processes that fall out and become manual in even the best of corporates and financial institutions. So I think you're right, and I think what we're going to see is a sustained investment in the infrastructure that's needed, both corporate and bank side, to support that sort of next stage of evolution. And I think it's both. I think it's banks and then, corporates, merchants, and other counterparties. I think consumers have it worked out. So, they expect it, they understand it, they have the technology in their hand, they're evolving that technology every 2-3 years in leaps and bounds. But, when I was at Barclaycard, we used to think about things like the point of sale estates, and these are on 7, 8, 9 year refresh cycles, and so to really change those, you're really talking about sustained investment in infrastructure.
What is the catalyst for making those investments, given that it's really the exceptions, these ad hoc use cases that create the friction? If everything is scheduled, it's the unscheduled things, it's the emergency payments, I have to pay this, this vendor twice a year, and it's a real pain to put them in the typical vendor payment system. Is that enough of a catalyst to force the change, or is it convincing, banks and relying parties to make the investments so that the majority of the scheduled payments today can be done more efficiently?
I think for me, it's recognizing that the sort of the infrastructure role, if you define the infrastructure based on a few small user cases, those business cases will never stack. I think what's interesting in payments is that there are so many variations in user case that actually almost becomes the sort of the philosophical adoption of infrastructure. So, we would think about, investing against trend rather than a specific user case. So, we know that over time, there isn't a world where banks' infrastructure must run more slowly or more based on batch, or must be, less capable to deal with change, or must be less flexible. That world is not happening, right? And so I think, when we're talking particularly to banks, where I think a lot of these transactions sit, it's about them really grasping that they can't specify all the underlying user cases. The market will determine which edge case flies, which fintech can develop on top of it, which application layer will be successful. But one thing that is required to make that work is just a foundational layer of infrastructure that runs at speed.
Yeah, I mean, after all, we are in the middle of the digital transformation. We are a digital economy, and becoming more digital, by the day, by the use case, by the fintech, by the innovator that is that sees a friction and is building a business around eliminating it. So I think you're right. I mean, if the reality is you need to keep up in order to keep up and to stay ahead, I would agree with that. What is the hardest part of innovating in the business payment space? I mean, yes, there's the infrastructure, but what about the process change? What about innovating some of the process changes that are also part of making the business payments efficiency story more real?
So I think for me, one of the things that is very obvious about payment business, but it's quite interesting to go back to first principles, is that it operates as a pervasive network. And so it's about, very, very broad reach and accessibility. And when you watch different types of payment scale, that's the race, right? Can you get as many send and receive critical mass endpoints to make the payment rail work? And I think the challenge with B2B and commercial payments is there isn't a single pervasive layer on top of the payments infrastructure. It's completely fractured. And I guess what that inhibits is the ability for network effects. Absolutely. But I think what that is doing is it's driving pressure then back into the payments ecosystem to say, well, what can you do to help? So, can you transit more information? Can you help us with additional pieces of, reasons code, identity information? But what that's really doing is kind of posing the problem back to the payments ecosystem to say, well, we know everybody is connected to that. If that can be enhanced, then maybe actually that solves for this, critical problem of there is just no critical mass in, single ERP, or critical mass in single general invoicing, or single critical mass in even the bank system that corporates are using, and even the way they interface with it. And I guess that's where particularly this concept of sort of national infrastructure level overlay services in payments becomes really interesting, because you can see some of those helping to solve for user cases specifically in corporate and B2B payments.
But is that where standards come into play, where, the ISO 20022 standard, now I know that there are different interpretations of how people are implementing that, but in theory, is that the common language that will help to create the network effects that you just described?
I guess if you talk to somebody who is all over that as a transformational piece of technology, I think they would say yes. For me, the interesting thing about the ISO 20022 migration, just more generally, is what organizations need to do is to stop dealing with messaging and start understanding the data and information in a transaction. And I think what that message format and what that content allows for is that, but it's not in and of itself a save. Mm-hmm. And what I mean by that is you absolutely could work out how to, catch and transmit information with an extra 20 data points in it. But if your systems don't understand what those data points mean, right, then it becomes almost impossible for you to derive extra value. So I think I kind of hope that the narrative around the use of ISO sort of evolves from, it started at data first principles, became about crashing into, the entire market, a standardized payment message, and it needs to evolve back through to, its roots, which is, we really, really systematically across the industry understand not just what field carries what specific content, but what does it mean? What's it for? What's its intention for? And I think if that happens, then, it has the opportunity to allow, really bright commercial organizations to innovate on top of it much faster than they would have been able to do otherwise.
Are those the conversations that you have as part of your remit on the Standard Advisory Council for the Bank of England?
Yeah, and this is one of the areas that we focus on because it's very easy to think about a standard as a sort of a fundamental set of rules, but if it's not understood, interpreted, and sort of actionable, if you like, by those participants, then what you get is exactly the same messages that were happening before, but just with the potential to have a little bit more information in it, and that doesn't really provide any material step forward. But I do think that in some markets the challenge has been placed to infrastructures to come up with those user cases. Mm-hmm. And I'm not sure that's the best way to do it. So I think user cases come from, competitive market scenarios much, much more readily than they come from actual central infrastructures and centralized bodies themselves, because there are just so many of them. And you never quite know which of those will materialize. And that, that's a very competitive and rapidly evolving space.
But standards, you referenced the card networks earlier. I mean, standards are what has driven, global scale of the card networks, because the innovation doesn't have to account for the variance of standards. I mean, there is a standard, there are the rails, there is the acceptance. And so the innovation happens on top of it, not to try to create something that doesn't exist and then innovate on top of that and hope everyone else follows along.
I think that's right. And actually, if you take the parallel out of the card environment and you look through again, the history of the evolution of, say, the data that's transited in that, you go back sort of 15 years or so, and it was unusual for level 2, level 3 card data information to be transited very effectively. Yep. That's much, much more prevalent now, but it's still not ubiquitous. Mm-hmm. So, there's very few places, I think, where you would see, scaled, full receipt information at a point of sale making its way through the card infrastructure. There's bits of it and there's pockets of it, there's user cases for it, but and that standard has been around for a very, very long time in a very established sort of network. And I guess this is the challenge, right? In those segments of the market where that was really valuable, so flight ticketing, travel information more generally, it got adopted commercially really fast, got built into those same travel and expenses processes and systems, and then you see a massive drive out in complexity and cost. And I think the account to account space will I think follow that same sort of evolution, provided that it gets the infrastructure right. And it gets those standards rolled out, but then it gets them really understood by the market.
Switching back to the catalyst for account to account and in real time, is the higher for longer interest rate conversation a driver for both senders and receivers to think about the return on investment of having cash available to them? I mean, and the business models that can be developed on top of it that monetize speed in one direction or another.
Yeah, I mean, I think the fascinating thing about higher for longer is it sort of polarizes the user cases massively.
Right.
So there becomes increasing value in speed and efficiency for those who need to borrow at scale, because the cost of that is significantly higher, and the marginal cost of payments in relation to that becomes significantly smaller. So net borrowing situations create conversion of large ticket borrowing facilities into many smaller, and that becomes efficient and effective because there's sufficient value in the higher interest rate on the borrowing side to facilitate those sorts of user cases. And I think the same happens the other way around. Yeah. So on the savings side, exactly the same way around. People who are either rate hunting or looking at I guess things like top up to save kind of mechanisms, it becomes worth it because there is just value in that efficient use of cash and credit. And so I think that's right. I think the higher for longer not only drives the user cases, but it also provides the potential for consolidation in the market and investment for those organizations that are benefiting from rates, higher net margin positions.
And a lot of innovation. I think, sometimes innovation doesn't have to be a technology. It can be a business model that creates an opportunity for both, in this case, for both stakeholders to feel that they've gotten a win, that they're successful. Payment accelerated at the same time. There's the opportunity to monetize the expedition of that payment in new and different ways. So I think that's where technology can facilitate these new business models, but I think the business models can be a really great opportunity for change.
Yeah, I completely agree with you. I think one of the things that's I guess very evident in account to account is that's not actually a technology looking for a problem. Right. That is a fundamental change in technology, which already has a whole range of different problems that can be satisfied by different types of organizations.
Yep. Are you hearing within the fintech space or the FI space this notion that my suppliers are valuable? I know that as a buyer, I can sort of set the rules, but I do care about the integrity of my supply chain. Therefore, I'm a little bit more collaborative and a little bit more sensitive to the buyer-supplier dynamics than perhaps in the past. And maybe in the past, pre-COVID. I mean, I think during COVID, people were really trying to be accommodating, given the business and economic circumstances.
Yeah, I think so. I think so. I mean, I guess it kind of goes down to what's the motivation and where are the pressures in that system? And I guess, even if you look at sort of fundamental inflation information, that is not consistent. There are huge variations in impacts in different portions of supply chain for different businesses. And so I think collaborative understanding between buyers and suppliers it's almost a prerequisite in the current environment because of these massive fluctuations.
Yeah.
and again, I mean, I'm not sure that's necessarily a specifically an interest rate challenge, but I guess the interest rate challenge amplifies it. So the consequences of trying to fund working capital positions on, very, very distributed and disparate inflation positions is a reason for a conversation, right? Because, particularly long-term contracts, those are, they were written in a different time, and surety of supply is a lot harder. And I guess it's perceived to be a lot more vulnerable post-COVID than maybe it was thought to be before.
And we'll see what happens in Q1 of 2024 as some of these things, as some of the rates and the contracts expire and are renegotiated. It should be interesting to watch. Yeah, the other thing that I wonder is driving the catalyst for account to account and in real time are how corporates, who are the customers, obviously, of the FIs, are pushing, because they're looking to innovate their businesses in new and different ways. So the pressure, isn't necessarily from solution provider to the FI, recognizing that, I can't afford to get slower and I can't afford to be even more legacy. But the corporate saying, look, I see these opportunities to innovate my business and I need this capability in order to do it.
I think that's very prevalent, and I think it's there will be some folks listening to this who are very aware of very large fintech and payment service providers that have moved banks over this.
Yeah,
it's that fundamental, and I think that absolutely drives a few things. It drives the requirement for banks who want to play in that space with those types of customers to invest in infrastructure and participate early in those sorts of activities. But I think it's a very real pressure, because as a corporate or a business, you want your bank to be an enabler, right? You don't want it to be you don't want to be worrying about how you can put off your business opportunities just because your bank hasn't invested. That's good.
Absolutely. Well, what are the things that you're going to be watching as we close out 23 and go into 24? Macroeconomic trends. I mean, what you may be seeing from FIs and fintechs on the topic. I mean, are there things that you watch carefully and then use to inform your own roadmap?
Yeah, for sure. I mean, I guess the first one is, they're clearly, the last 5, 6, 7 years from a fintech perspective has been a race to scale.
Yeah,
I mean, it's what it's all been about, right? Like who can get big enough to survive, I guess, effectively the environment we're in now. So, I think consolidation and the associated ability for those consolidated businesses to put together different user experiences, I think is going to be really, really interesting. I think the second area for me that we would continue to watch is how the fraud environment evolves. So I guess as pressure is driven into households and economies from higher rate environments, we can all see the rapid increase in fraud and how different technologies, and particularly something that we're investing heavily in, is how do we help with that? How do we take the information flow and the processing flow across our platform and use it to really try and preempt and prevent those fraud transactions rather than recovery and restitution later. So I think those things, as well as a general trend to invest once in big in modernization programs and then really leverage that into real time. I think all of those are really important for us.
What about the GPT of business payments?
So we're starting to do the thought process on this, and I guess what we do fundamentally is plug banks into central infrastructure. So we're a bit less about digital experience and a bit less about the sort of the front end consumer. But as a result, actually, the big thing for us about this is the inherent security and the management of security using those types of tools. So we're working through where that would be applied. But I think in business payments, I guess it's going to create an entire ecosystem of micropayments.
Absolutely.
And that only really thrives in a high speed real time, cheap to deliver payment infrastructure. And I guess from a payments perspective, that for me is going to be the really interesting trend. You know, how would people send fractions of value, you know, very regularly, to deal with these sort of new sort of call based or model driven AI business models.
Yeah, no, I think it's going to be really interesting, especially when you start to think about how content is going to be monetized across these platforms, because, you know, there is going to be this, you can't just steal my stuff. You have to attribute the source, and you will have to monetize that. And that is where, you know, that is one use case for the fractions of the fractions of the fractions, but there will be many others. I mean, we don't know, because the technology is so new and innovators are, you know, coming up with new ideas every day. But I think it's such an exciting opportunity for this technology to be put to work, you know, across payments, regardless of whether it's consumer payments or commercial payments.
Yeah.
So watchword for 2024 from where you sit is what?
Oh gosh. I think it's consolidation. I think this is the thing that I think is going to be really interesting. You know, consolidation of user cases, businesses, and the resulting scaling of flows, I think is going to be a game changer for the market. Much less fragmentation and much more sort of consistent, amplified user cases running at speed. I think is going to be really interesting in 24, 25.
Mike, thanks so much for your time. Great conversation. Thank you.
You too. Thanks very much, Karen.